Hello, hi, welcome back. In this video, I'm going to continue where we stopped yesterday. That is on analyzing transaction. You want to see the effect of each transaction to our accounting equations, whether there will be any change to our assets, liability, equity, revenue, or expenses. So let us go to the example. The first example today is based on Rohan, where he received a sum of money of $570 as a partial payment. So this payment was made by his client who previously purchased the items received the service but did not make any payment in the previous date. So what are the account involved here? The first one will be assets. Our asset will certainly increase because we receive a payment of $570 from our client. The second account will be account receivable. This is the amount of money that we expect to receive, that we are going to receive from our clients. So when we receive the payment from the clients, this account should be reduced. So cash increase, account receivable will decrease. So we are looking at the accounting equations. Assets is equal to liability plus owner's equity. Both accounts fall under assets category. So there will be increase in cash, reduce in account receivable, but there will be no change in liability and owner's equity. So it balances. If I look at the calculation here, previously our cash balance is 470. With the additional 570, the payment received from the clients, our total or our new balance of cash is $1,140. Whereas for our account receivable, originally the value is $600. Our client make payment of 570. So the amount we expect to receive from our client reduced to $30. There are no changes to the supplies, prepaid insurance, and delivery equipment accounts. So the total assets is $3,450. There is no change to our liability and owner's equity. The total liability and owner's equity remain unchanged. That is $3,450. So it shows that our accounting equations is balanced. Assets is equal to liability plus owner's equity. Let us move to the next example. In this example, Mr. Rohan purchased delivery equipment and assets. This is assets. For $300 cash and the remaining $1,200 on accounts. So this asset value, if you combine this value $300 and $1,200, we know that the value of this asset is $1,500, whereby we make payment by cash of $300 and the balance we borrow from our supplier maybe. So this is the transactions. So we have three effects on this account: increase in asset, reduce in cash, and also reduce in cash and increase in liability. So what happened actually? Rohan is buying this delivery equipment by paying some cash now and the rest on accounts. This will be our account payable. He will be making payment on it over the next 4 months. So the remaining 1,200 will be paid to the supplier in 4 months period. So There are three accounts affected here. The first one is cash, second is delivery equipment, and third, account payable. Certainly, the cash will reduce. The cash will reduce because we took the money out and make the payment to the supplier. Our asset will increase because we have new delivery equipment now, and our liability will also increase. Our liability will also increase. Yeah. Okay. So our cash will reduce by 300. Delivery equipment will increase by 1,500. This is the effect on our assets. For our liability will increase by 1,200. From this equation, you see that the 1,200 increase in asset and also 1,200 increase in liability. So it balanced. So what happened to our current balance? Our cash account before this is 1,040 minus by 300 minus by 300. So our new balance will be 7,400. And there are no changes to the account receivable, supplies, prepaid insurance, delivery equipment. Okay, the total asset value is 4,650. For the liability and owner's equity, since we make payments of, we took loan of 1,200, so our liability will increase to 1,800. Liability will increase to 1,600. 1,000 to 1,800. That is increased from 600 by increase 600, add another 1,200. That gives you 1,800. So the total liabilities and owner's equity is 4,650. The next example is about expenses. Yeah, Rohan paid his part-time employee 650 in wages. So this is a payment of wages to our employees. So this payment will reduce our cash. When we make the payment, it will reduce our cash and also increase our expense. So wages expense will increase. Wages expense will increase. However, our cash will reduce. So wages expense increase, cash balance will reduce. So our cash will reduce by 650. If we are looking at this liability plus owner's equity, there will be also a reduce in liability on owner's equity. Certainly, we will go to the owner's equity account, whereby increase in expense will reduce owner's equity. Increase in expense will reduce owner's equity. So how are we going to do this? We look at this balance. Our cash balance is 740 minus 650. The new balance of cash now is 90, reduced by 650. So the total asset is now $4,000. It's now $4,000. Let us look at our liability and equity side. Okay. Previously, our expense is 250, and now we have an additional expense, wages, 650. So the total expense is 900. The total expense is 900. Our total liability, this is our total liability, is 1,800. Let us look at our total owner's equity. Okay, what is the formula? 2,000 plus is capital plus revenue 1,100. So you get 3,100 and then minus 900. So our owner's equity, the value, the balance for owner's equity is $2,200. So we can see our owner's equity reduced, but the total liability and owner's equity now is 4,000, which is equal to the total assets. So please always remember that revenue increase the owner's equity, whereas an expand will reduce owner's equity. The next one is Rohan received delivery fees as follow. Rohan provided the services to the clients and he received 430 in terms of cash. This is a cash receipt whereby the balance is on accounts. I mean the customer promised to pay at a later date. So the total revenue will be, you need to add both figure, okay, 620 plus 430. This is your delivery fees revenue. That is $1050. Okay. So there will be an increase in cash. Certainly, our cash increase. Our account receivable amount expected to be received at a later date also increase, and our delivery fees revenue will also increase. Why delivery fees is our revenue? Because this is our main business. We provide delivery services, so our customer will pay these delivery fees to us. So this is why we call it as revenue. And revenue certainly will increase our owner's equity. So what will be the new balance on our asset, liability, and owner's equity equation? Yes, cash increase, owner's equity increase, so our delivery fees or revenue will also increase by 1050. So let us look at our cash balance. Our cash balance will increase from 90. We add another 430, so the new balance will be 520. Whereas our account receivable, previously we have 30 plus another 620, the new account receivable will be 650. There is no change to supplies, prepaid insurance, or delivery equipment. So the total assets is 5050. Yeah, 5050. Increased by 430 and 620. Account cash and account receivable. For our liability and owner's equity side, there's no change on our liability and also capital, but our revenue will increase. So our revenue increase from 1,100, now we have a new one, 1050. So the total revenue is 2150. Liability remain unchanged. This is our liability. Okay, but our owner's equity has changed. 2,000 plus the revenue 2150 and then minus 900. Yeah, so you get here 2,000, 4,150. So you have 3,250. So if you total your owner's equity, the value is 3250. That is 2,000 plus 2,150 minus 900. So you'll get 3,250. If you add up these two numbers, liability and owner's equity, this gives you a new value of liability plus owner's equity, 5050, which is equal to the amount of total assets. Okay, we move to the next question. There is one student who asked me about withdrawal or drawing. What are the effects of drawing? So Rohan withdrew 150 for personal expense. So this is drawing. So we withdrew the money, certainly the cash will reduce and the capital will also reduce. The act of withdrawing basically is taking out the capital from the business. So there are few things that we must remember. Let me just explain again. Rohan is withdrawing some of his equity in the business by taking home an asset that is cash. This will reduce the asset and also reduce his owner's equity. So there are two items involved. The first one, we are going to record it as a drawing. Drawing will increase and your cash will reduce. Cash will reduce. So drawing increase and cash reduce. The drawing will have effect on the owner's equity, whereby the owner's equity will reduce. Increase in drawing will result in decrease in owner's equity. That is the indirect effect. So be careful. Just like expand, the drawing account will increase in this situation, but overall will cause a decrease in owner's equity. I repeat again, there will be an increase in drawing, similar like an expand. The drawing account will increase in this situation, in this example, but overall it will result in decrease in owner's equity. So let us look at cash first. There will be reduce in cash. Our asset will reduce by 150, but our owner's equity will also reduce by 150. There is increase in drawing will reduce our owner's equity. So the new cash balance will be 370, which is equal to 520 minus 150. 520 minus 150 drawing. So our new cash balance will be 3700. So the total assets now, total asset is 4900. So this is our assets. This is our asset. What happened to the liability and owner's equity? We have a new account here. We created a new account, 150, that is for drawing. So account payable or liability remain unchanged. This is liability. For the capital, we have a new item, 150. So this amount of drawing, increase in drawing, will result in lower owner's equity. So let me share with you the formula. What is the formula to identify owner's equity? I repeat again, it will be capital minus drawing plus revenue minus expense. I repeat, capital minus drawing plus revenue minus expense. So it's going to be 2000 minus 150 plus 2150, and then another one is going to minus your expense. Always remember that owner's equity is equal to capital minus drawing plus revenue minus expense. So the total owner's equity will be 2000, 2000 minus 150 plus 2150 is going to be 4000. 4000 minus 900 is going to be 3100. It's going to be 3100. So this is your owner's equity. You add up these two numbers, 3100 and 1900. This gives you 4800. So asset is equal to liability plus owner's equity. Your asset previously was 4900. This is your asset. Your liability is 1800, and your owner's equity is 3100. So it balanced. Okay, so that is the process. Few example on the effect of each transaction on accounting equations. So let us move on how we're going to prepare a basic financial statement, the income statement, statement of owner's equity, and balance sheet. Okay, these are the statements that we are going to prepare. The first one is going to be income statement. Second, followed by the statement of owner's equity. And third will be the balance sheet or statement of financial position. For the income statement, it reports the profitability of the business operation for a specific period of time. Expenses are subtracted from revenue to determine net income or net loss. So we are comparing between our expense and our revenue. If our revenues, total revenues is greater than total expenses, so we make profit or income. Otherwise, if our expenses, total expenses, is greater than total revenue, so the company is suffering a loss. Also called as profit and loss statement, or sometimes can be operating statement. So we start with the date first. We put the date, so we start with the title. Put the business name, the name of the documents, and the period it covers. So financial statement heading consists of the name of the company, the title of the statement, and also the period covered. Okay, and then we normally have 3 columns like this. Okay, we use the first column to list all the item. The second column we use for total. Okay, and next one we put the figure over there. So let's start with the revenue first. So we put the revenue. We start with the revenue. Put delivery fees, and the amount of revenue is 2,150. So this is our revenue. Okay, and then we put the expense. The expense, we list all the expenses. We have wages expense, rent expense, food expense, 3 types of expenses. So we put the value here 650, 250, and then we put underline before total, and then we put the total here 650, 200, 950. So this total, you put it down here. So it will be much easier for you to subtract, yeah, the figure later on. So and put it in. Normally I'll put a bracket here, so you won't get confused with that. So it's going, your net income will be 2150 minus total expense 900. So this gives you net income of 1250. Revenues are greater than expenses. Therefore, the total is called net income. Yeah, I repeat, revenues are greater than expenses. Therefore, the total is called net income. This is your net income. How much is your net income? 1250. Okay, 1250, and then you double underline the net income total. Double underline the net income total. Okay. Next, the second document is going to be statement of owner's equity or statement of changes in owner's equity. It report the changes in owner's equity. Okay. So we use the net income figure from income statement. Why? Because that has great impact on our owner's equity. I did show to you that owner's equity, the formula is your capital, your opening capital. Yeah, this is your opening capital. I call it the opening capital plus revenue minus expenses minus drawing. Okay, revenue and expenses. Now we have a profit. We have a net income of 1250. So this is our revenue and expenses come from our profit and loss statement. So we now, to determine our owner's equity, we need to use this formula: capital plus net income minus drawing. I think our drawing is 150 if I'm not mistaken. So let us go to this statement. Okay, this is not the income statement. This is statement of changes in equity. Okay, this is statement of changes in equity. So what you should do now is start with the capital plus the net income and then minus the drawing. So 1250 minus 150, that gives you 1100. This is an increase in capital. Okay, so your capital will be 3,100. This is the latest or the closing capital, 3,100. You start your business with a capital of 2,000, then you make a profit of 1,250. You withdrew 150, so your new capital will be 3,100. So this is your new capital. And finally, we look at the balance sheet. what is balance sheet? Balance sheet is a statement listing all the assets, liability, and honest equity at a specific date. So this confirms the accounting equations. So we have the basic accounting equation: assets is equal to liabilities plus honest equity. So this is the T format, T account format. So we have the date, put the date first, okay. Rohan campus delivery, the balance sheet as at 30th June, maybe 2020 or 2021. And then we list all the item, the assets. So this is the asset, cash, account receivable, supplies, prepaid insurance, delivery van. And you put the figure, the total is 4,900. Our liability is 1,800. And please be careful. Over here under honest equity, we took the value from our statement of changes in equity. So this is the new honest equity balance come from statement of honest equity. So liability is 1,800. So the honest equity is 3,100. So the total liabilities and honest equity is 4,900. Okay, let me just explain this again. Okay, from this balance sheet, we know that we have a total asset worth 4,900 consisting of 5 types of asset, that is cash, account receivable, supplies, prepaid insurance, delivery equipment. If you want to know the detailed amounts, then you know that this is the amount here: cash, account receivable, and so on. So when you look at your liability, where the liability is 1,800 and your honest equity is 3,100. So this is your total, your new honest equity. I think with that, I end my video. Thank you so much for watching. Study hard and good luck. Bye-bye.